Good afternoon, everybody. Welcome. Glad you were able to join us today. It's that time of year again. It's hard to believe. I can't wait till the weather warms up because I'm dying. But 2025 year-end review, 2026 market, economic, and investment outlook from both Lou DaCosta and myself over at Beacon Wealth, soon to be Inovo Wealth Architects. We are senior wealth architects at the firm. Stay tuned for more to come on that if you haven't heard, but this is some exciting news that we have for you. We got a lot to cover today. A lot's going on. Obviously, we're now already in February, but you know what? January was thus far was a really good month. When you think about some of the things that have occurred and some of the things that we're going to talk about, this is why we always wait till February. The January barometer and the January effect is a real thing. When the first 5 days of January are positive and the month of January itself is positive, that bodes well for the markets moving forward. So we're going to hop right in. But listen, before we do that, just a little bit of housekeeping. Understand that anything we talk about today is not a recommendation. This is just views and opinions from both myself and Lou DaCosta here on the call. Please obviously consult with your tax advisors and your attorneys as these are not forward-looking statements. Last but not least, securities and advisory services are offered through LPL Financial, a registered investment advisor, member FINRA and SIPC. So let's hop right in. By the way, Lou, are you ready for it to be a little bit warmer out?
Dude, I cannot wait. I am having such cabin fever. Even with all the skiing going on, it's just even it's too cold to go skiing right now, man. So I
Yeah,
cannot
yeah.
wait.
The lakes are frozen over by my house. There's new activities that are happening on the weekends. It's called walking on the Navesink River. I've been living in down by Monmouth County for 7 years now. Never seen it. I'm not doing it. I'm not doing it. That's not my thing. So I'm gonna sit in the house and stay warm and maybe talk a little bit more about, investment and the markets. So 2025 was a year in which global markets were driven less by traditional fundamentals more and more from fiscal and monetary policy decisions. On top of that, technical analysis really shined through, right? So as a result, markets experienced sharp swings between policy-induced lows and momentum-driven highs. You remember in April, Lou, what happened? March and April, what happened, right? I mean, we had
Yeah,
politics
tariff
stepping
tantrum.
into the mix, tariff tantrum, right? Oh, God, that was an interesting time frame, but who knows? People have forgotten all about that. Before we get into the specifics of the year, check this out. This is what many of our clients believe their plan is actually like. But in reality, this is what it's really like. I mean, listen, it's not a straight line. We're not going from, womb to tomb or, work to retire, work optional in a straight line. We're going to have to walk on water. I guess now that's pretty easy, right? I mean, like I just said, we're walking on the Navesink River. You may have to do some rock climbing and, pass through a tornado here and there. And then eventually you get there, right? I mean, this about sums it up. What do you think?
I think that's total reality, Anthony. That's in any part of your life, not just your financial life. That's just how it works.
There you go. You gotta love it. Understand it's not a cakewalk. It's a marathon, and you're gonna hit some bumps and bruises and roads and bridges that have fallen off the. We're gonna take a few detours along the way, but understand we're gonna get you there. 2025, great year for diversification. This is why we always talk about it. I'll be honest, for many, many years, diversification was just it actually worked against you, right? And everyone kind of started to, turn around and say, hey, does it really work? Yeah, actually it does, right? I mean, if we look back, over the years, right? Going all the way back to 2010, all the way up until 2025, just look at international emerging markets, right? I mean, 2025, they were the leader. Well, where were they in 24? Where were they in 23? Where were they in 21? Right? They just knocked the covers off the ball. International developed markets coming in at number two in 2025. Again, where were they in 2024? It's not just all about, VOO and chill, buy the S&P 500 and forget about it. Like diversification can and will work for you, and it could smooth out the path when it comes to investing for the long term. So what you're looking at here is a quilt chart. Each color represents a different investment category, ranked from best to worst over the course of the years. What's the one thing that stands out most to you, right? Lou, if you look right down in the middle of the page, a balanced portfolio, a moderate benchmark. You may not always be hitting home runs, but you're certainly going to hit singles, doubles, and you're not going to strike out all that often. So, something to consider, something that we talk about and preach all day long.
Listen, if we could smooth the ride out as much as possible, I think that's what everybody wants anyway. Yeah.
Absolutely. When we talk diversification, we talk commodities, we talk gold, we talk infrastructure, we talk alternative investments. All these items are critical for managing risk. Aside from, coming into Christmas when silver shot up through the roof and right after Christmas, fell through the floor. Generally speaking, right, all these types of vehicles are designed to help smooth that path, smooth out the ride, stay diversified. And, not everything should be working together. You want to have, investments inside of your portfolio that, are doing different things for different reasons. Because again, the goal is to minimize volatility and minimize overall impact, or minimize, the feeling for our clients to say, just get me out, because that's the worst thing that you could do. Economics and policy. What do we expect in 2026? We expect, believe it or not, we expect a slow start. We've already kind of seen that a little bit. January, it was positive, but we saw some volatility creep in late in the month. But with economic growth weakening for the first quarter, as higher rates, the higher for longer, kind of soften consumer demand. Inflation is still pretty sticky, although it is coming down. Labor, it's there, right? I mean, even if it is 2%, even if it is 2.5%, whatever the number is on a month-to-month basis, that's 2.5% on top of the 9 that we got a couple years ago. So inflation is still there. You go to the grocery store, everybody sees it. We get it. Obviously that creates softening consumer demand, and obviously the big thing that we want to highlight, and we're monitoring, obviously, is the cooling labor market. All that stuff weighs on activity. This chart that you're looking at here shows U.S. GDP growth trends from 23 to 2026 forecast period. Obviously, if GDP was strong in 23, peaking near 4.7%, and economic expansion moderated throughout 2024, only briefly contracting in 2025. All this is showing is that it's indicating a slower but steady economic environment. We talked about it already. Inflation and labor, and it's still there. It's above target. Yes, it's coming down, but it's still there. When you shop at the grocery store, my bags get lighter and lighter. My bill gets higher and higher. It's frustrating. Some of these things are temporary inflation pressures that we think may subside throughout the year. The big, again, 800-pound gorilla that I mentioned already, labor markets are cooling. My wife works at an organization that is funded by Verizon. Verizon now announced mass layoffs last week. Amazon announced mass layoffs. It's happening, right? Labor markets are cooling. Hiring is slowing. This has really become the primary driver of Fed policy decisions. What do we expect from the Fed? Well, we expect them to continue the gradual rate cutting, due to moderating inflation and a softening labor market. The Fed is working towards a 3% short-term rates, right? And hopefully short-term rates fall faster than long-term yields, right? So, look, I don't know. What do you think? I mean, I'm thinking 1 to 2 cuts this year, maybe more. It all depends, but that I think that's our best guess, right, at this point. Unless something dramatically changes. Would you say, Lou?
Exactly, Anthony. Probably two, I would say. Three, maybe a little tight, but let's see what happens. Anything can happen in this crazy world we live in.
When rates come down, it's actually a good thing. Why? Well, I shouldn't say that, right? It's not always a good thing. It could be a good thing as long as they're not coming down for all the wrong reasons. When rates come down, it's a good thing because, generally speaking, mortgages are based off the 10-year treasury. And obviously, they also, there's a factor of mortgage-backed securities in there, but mortgages are based off the 10-year treasury. And if that continues to come down, well, that means mortgage rates continue to come down. So that spurs refinancing activity. Maybe it spurs a little bit more buying and selling. The people that are sitting, thinking about possibly moving or refinancing now have the ability to do so. All these things stimulate economic activity, right? So it could very well provide a little bit of a tailwind to the real estate space that in most areas outside of our New Jersey bubble that we live in from a real estate perspective, not bubble in a bad way, but bubble in that we haven't seen, a lot of the negative pressure that the rest of the world has seen. So maybe that'll give the rest of the world a little bit of a tailwind.
Absolutely. And Anthony, don't forget, this also helps with student loan debt, right? Car purchases, if you're taking a loan out, it affects a lot of different areas of the economy.
Absolutely. So this has been a hot topic of late, right? Technology is spending, and they're spending in a big way. AI related CapEx spending is just, it's reaching historic levels. There are some concerns out there that it's gone a little bit too far and they haven't really figured out how to monetize this spending yet. But I'll tell you what, big capital expenditures over the past decade led by Microsoft, Alphabet, Amazon, Meta, and Oracle, right? It would certainly lead to, future growth, right? So total CapEx spend is expected to exceed 500 billion, and a lot of it will be in infrastructure and data centers but this is a driver of corporate investment. And when corporations invest in themselves, that means that they believe that the future looks bright, right? Don't forget though, like when, big investment phases do bring volatility. I mean, let's talk Oracle, right? Like they're one of the largest companies spending money in AI, right? Last year they were on a pretty big ride. They rode, they started they finished the year about where they started the year, but throughout the year they were up over 100% at some point and then came screaming back down. Again, they're spending in themselves, they're spending on AI, but that comes with volatility. When they figure out how to monetize all the money that's being spent and the innovation that is happening within themselves, wow, that's going to be a powerful, powerful tailwind to GDP growth and it may listen, it may add roughly 60 to 80 basis points, on overall GDP throughout the year. So stay tuned for more on this. Tariffs, right? We're still talking about them. Tariffs are higher, but let's face it, you know, the worst case scenario didn't materialize, right? I mean, this was a really, really, really big topic of conversation in March and April of last year. We're not here to get into any political conversations, but the fact of the matter is, the worst case scenario that some pundits were predicting just didn't materialize. So, look, I mean, this chart highlights the recent rise in U.S. import tariffs. The effective tariff rate increased from about 2.5% in 2024 to about 11.2% in 2025, reflecting those new trade policies. However, excluding certain targeted measures, right, the effective rate is really closer to 4.6%, suggesting that while tariffs have risen meaningfully, the broad economic impact may be less severe than what headlines initially, implied. So I see that global market environment, right? So let's talk a little about how global markets are increasingly policy driven and trade certainty, coupled with geopolitical uncertainty may stunt Eurozone growth, right? Global markets, in our opinion, can create a tailwind for U.S. economic growth, right? So when we look at GDP growth forecasts over year, our expectations may see that in 2026 into 2027, the U.S. may hover somewhere around the twos, but look at emerging markets. Look at the global markets, right? Like we think that a lot of, we have a weak dollar currently happening at the moment. Like we think that all these things can bring back the global economy, right? We got away from that for a period of time. Everything was domestically biased. I think that changes. I think this year may very well be a very good year for, global markets as a whole. All these countries are benefiting from, a softer dollar. It'll be interesting to see how the year unfolds, but I think it's all good stuff. So here's the fun part, right? Equities, right? This is what we do, this is what we talk about all day long, right? Let's move into a hot topic here, equities. I made a mention early on that markets, are reacting to technical analysis more than fundamentals, and certainly, of course, policy is driving a lot of the volatility that we see. But here's the truth, right? The market turned three late last year. The bull market turned three late last year. You know, believe it or not, the average bull market is a lot longer than 3 years, right? The average bull market is about 5.5 years long. So that means we might be, it may very well be still young, right? I already said when the first 5 days of January are positive, which they were, and the month of January was positive, which it was, that usually bodes really well for the full year in the markets themselves. And when you put those two things together and they happen in the same year, it's actually really strong and really powerful. So here's the reality of it. We're in year three. Year four historically is not a negative year. We think we're still in a bull market, and frankly, it still may very well be a young bull market. Could there be some things out there that change this thought process? Sure, but right now, what we're seeing on the technical side is we still have room to run.
Absolutely, Anthony. And full disclosure too, right? We're not saying that we project it to go straight up. There definitely will be volatility throughout the year, just like there is in any year. So just keep that in mind too.
There you go. I mean, I think you might have read the slide before I even changed it. So see that good minds think alike. He was already one step ahead of me. He's talking about volatility. Yeah, no question about it. Volatility is going to be here. The truth of the matter is pullbacks are going to happen. We'll talk a little bit more about that on a later slide. He's already beat me ahead of it, but listen, the current bull market is tracking generally within historical parameters, but the fourth year of a bull market is usually pretty good. Stay tuned for more. Fingers crossed, fingers crossed on that one. But earnings are rising. Earnings are a really powerful driver to economic growth, to market return. Fed's cutting rates. Look, when all these things, when you got productivity gains that are expected to come from AI, you're in the fourth year of a bull market, which is historically pretty strong. You got two positive January barometers. The Fed is cutting rates. When all those things happened in the past, the markets were up double digits 12 months later on average. So I'm not saying history repeats exactly, but it certainly does rhyme. But earnings, right? The Magnificent Seven still remains a powerful earnings driver. And not only that, but guess what? Earnings are expected to move higher. So if earnings drive the markets and the Mag 7 is a powerful driver of earnings, and now we expect breadth to widen out and earnings to come from, the other 493 companies in the S&P 500, that's an important driver of future returns. So, look, this is all good stuff. We're really optimistic about, not that we don't like the Mag 7 anymore. We're really optimistic about the other 493 companies that are out there in the S&P 500. So,
Right. Anthony, again, it goes back to diversification, having that balance, right? We don't want to put all our eggs in one basket with those seven companies. And by seeing this widening out, it just helps, the overall performance and long-term growth.
it wouldn't be a full presentation if we didn't have to talk a little bit about politics, but we're going to keep it very, very general. And we're really going to just, allude to the facts. We're in a midterm year. There's no if, and, or buts about it. We're in a midterm year. So listen, since 1950, midterm years really have been the most volatile. There's, historically speaking, they generally have the largest intra-year pullback at approximately 17.5% on average. Keep in mind, last year we did get a 19.6% pullback, peak to trough from March into April. The positive thing about midterm years is, although they have the largest intra-year pullback or intra-year drawdown, they actually also deliver the strongest rebounds, right? Believe it or not, the S&P 500 averages a 31.7% gain in the year following the market low. So if history rhymes, expect volatility like Lou mentioned earlier on, but also expect a rapid recovery right after that. On a separate note, and coupled with the fact that we're in a midterm year, and yes, you can argue this a little bit, but the current administration is currently a second term president. No, it is not back to back like some other, second terms have been, but this is a second term president. When you couple the midterm year under a second term president, the average, the rebound that we see is even stronger than a first term president. So again, more technical metrics that point to tailwinds for equities throughout the course of 2026. Bonds, maybe a little bit boring, but you know what? Maybe not, right? This year, if rates are going to continue to decline, that bodes well for bonds. The 10-year treasury is generally highly correlated to the expected federal funds rate, trough rate. So, look, if the Fed funds rate continues to decline, one would expect the 10-year treasury to continue to decline as well. As we all know, bonds have an inverse relationship, right? Rates are high, prices are low. Rates come down, prices go up, right? It's the basics of a bond and bond market investing. So if rates come down, prices on some level have to increase. That bodes well. So maybe they're just not so boring this year. Spreads for credit markets, right? What you're looking at here is three different metrics across several periods or categories showing average outcomes, typical ranges, and variability interact. The dark bars are going to highlight the primary performance measure, while the markers show supporting risk and volatility measures. The key takeaway here is the higher performance periods often come from higher variability, reinforcing the importance of balancing return expectations with risk management, right? But spreads for most credit markets are really, they're below long-term averages. So, even if spreads start to increase, which means there's going to be a little bit more risk on the table, we still think we're in a good place, in most areas of the credit markets and in the credit space. Bond returns are expected to be primarily income driven, and we favor high quality, intermediate maturity bonds and mortgage-backed securities, right? So yes, we may get some appreciation of the bonds themselves, but by and large, we think, bond market performance primarily comes from the income derived from the bond itself. The fortunate part about it is we still are in, compared to the past 20 years, we're still in a higher interest rate environment that we've seen over the years, which tends to bode well for bonds themselves. And since we are starting off in a much higher place, and everyone makes this argument, well, inflation is still here. Anthony, you said that already. But Lou, like we're not starting from zero, right? I mean, in 2021, we were at, we still had zero interest rates. Like, so if we're already starting high, I don't know. You tell me. I mean, I think it makes a repeat of 2022 unlikely. Even if there is some more inflation, I think rates stay, they maybe they're just higher for longer. They don't, maybe they don't go down as quick. I don't think they go up dramatically as certainly not as fast as they went up in 2022. What do you think?
100% agree with you, Anthony. Depending on what interest rates do this year, but if they're going to have two rate cuts, I really don't see this moving too much in one direction or the other.
Let's talk alternative investments, right? M&A activity is building and larger deals are being executed every day. I mean, there's been, late last year, there was some really, really, really big deals that have occurred. I mean, there's deals happening almost on a daily basis. When M&A activity is active, that means that companies are willing to spend money. They want to buy, they want to obviously partner with other organizations. They want to look, they want to just it means they're investing in the overall economy. Like this is a good thing. So M&A activity is building. That means, like longer term trends remain positive. That's the bottom line, right? The longer term trends remain positive. The dollar's down, but it's not out. No, we're not being overtaken by some other currency right now. The dollar is down. The dollar's been volatile over the years. There's no question about it, but the long-term uptrend still remains intact, in our opinion, for the dollar. To break that long-term, uptrend, the dollar would need to fall below the September 2025 values, of not near 96. So we still think we're in a secular uptrend, and we're still showing signs of support with the dollar, despite what the media wants you to say. Remember, the media is designed to sell ratings. If they don't captivate your imagination, or captivate your attention, like you're not coming back. They're designed to get you to come back. So take it with a grain of salt. We're not being overrun just yet. Commodity markets, yeah, they were volatile in 2025. It was driven by geopolitics and trade policy. There's no question about it. But commodities are, in our opinion, are on the verge of a breakout, right? Potential rate cuts and lower treasury yields, yeah, it may weaken the dollar, but it provides a tailwind for commodities, right? Oil, gas, right? Materials, metals. I mean, we're already seeing, obviously what it's done to gold, silver, platinum, the precious metals, but what about copper and all these other metals that are out there, infrastructure? Don't count them out, right? Commodities are a great place to be. They're a great diversifier. And the rest assured that a lot of geopolitics have been the important factor behind gold's outperformance. So, when geopolitics, factors subside, we think that there may be, you may start to see some kind of flattening of the volatility in the gold and precious metal space. We're not saying that you don't want to own it. That's not what we're here saying. But what we are saying is you want to be mindful of where you enter into. Just don't chase that gold return. So what's the bottom line, right? What's the bottom line in the alternative investment space and overall global market space? Like this is what we're all here for, right? We're all here to, you know, to hear what we have to say and hear our thoughts and opinions. Look, we expect a wave of policy support and AI investment to limit economic risk and extend the current economic cycle. Okay? All those things we think outweigh, some of the negatives that are out there in the market and in the media today. Economic expansion should support earnings growth and could potentially set up stocks for an above average year. Weak dollar, global GDP growth has the potential to give international equities another really good year, right? And exposure to international equities, we think should provide valuable throughout the course of 2026. Tech is still the leader, but guess what? It's starting to broaden out, right? It's starting to broaden out, and we think that trend continues. Bonds and cash expectations are balanced, but bonds certainly can be a better diversifier than cash right now. And look beyond bonds for diversification, commodities, private equity, right? All those types of alternative investments. And like Lou mentioned before, there will be some setbacks. There will be some negative press. There will be some volatility. But stay focused on facts. Stay focused on history. Don't focus on fear. Just some thoughts on where we think, where we're looking to allocate, for our clients' assets this year. Yeah, we're still going to own equities. We think we might be a little bit overweight equities than we are in prior years. We're gonna have some exposure to both international and emerging markets, although we may be a little bit under what we would have recommended last year for international markets, or I should say for emerging markets. We certainly like large cap, but we're starting to see some breadth, and we're increasing mid and small cap exposure, right? And then, of course, obviously, fixed income. We like the treasury position, and then, of course, cash and other diversifiers. Again, these are just our views. These are just our opinions, right? But we think we may very well have an above average year. We think that stocks could potentially fall somewhere between 12 to 15% throughout the course of the year, and bonds may return somewhere in the vicinity of 3 to 5%. Listen, this is our best guess based on what we're seeing out there in the market today. There's a lot of things that can change this, that can change this number. But if history rhymes, we think this is, a good place that we may fall. So that was it. That's all I had for you. I hope that, you guys got a little bit of value from this presentation. I know we went through it pretty quickly here, but look, despite the fact that we've seen, I don't know, below average temperatures here in the Northeast for the better part of the past several weeks. I mean, heck, I don't. I shouldn't even say the Northeast. I mean, my in-laws were down. They in the wintertime they lived down in Florida, and it was 30 degrees down in Florida multiple times, right? So the whole East Coast has gotten smacked with it, and certainly we've seen some ice storms. But like history, it always warms up in March. It always warms up in April, and we think the markets and the economy and everything else will do the same. Don't let that deter you. So that's all I got for you. Look, Lou, I don't know. You got anything else to add? Anything else to say? Before
Yeah, I mean, listen, I would just say, whatever you guys are thinking, if you have any issues, concerns, we're always here to help you. We joke around a little bit because I feel like sometimes we're a little bit part psychologists. But we're here to help in every single way, and we want to get you to your goals and as soon as we can. And whatever you guys need, you know where to find us. And here's looking forward to a great year.
Yeah, I mean, obviously, I'm looking forward to it. And I will just say one final time, for those of you that aren't aware, we went through a rebrand. So this presentation is dual branded BeaconWealth and Inovo Wealth Architects, but you know, we're architects of financial freedom. Like that's what we do. You guys come to us because you have a goal in mind. You guys have something's just not right. You're trying to figure out how to get to where you want to in life from a financial perspective. And it's our job to build that roadmap to get there. And that's exactly what we do. Similar to an architect that builds a house, we are architects of financial freedom. And I think that we're pretty innovative. We're not just, this is all we do. We think outside the box. We're always looking to, come to you with creative strategies, innovative strategies that, in our opinion, are changing the game. We're changing our fee structure. There's a lot of things that are going to happen that are coming down the pike throughout 2026 that in our opinion, are innovative in the financial world. So, that's Inovo Wealth Architects stands for clarity, confidence, right? And we bring together health and wellness, right? Now, we're not just, Lou said, we're psychologists. We're not just only talking about your finances. We're talking about, how do you become, how do you get the most out of your life, both from a, from a wealth and a health perspective. And we're here to be, we're here to build together. We're here to collaborate. So you guys are going to really like some of the stuff that comes out. So soon, more to come, but soon to be Inovo Wealth Architects. The last thing I will say is, if you're not aware of our new phone number, please, and you're listening to this presentation and you made it all the way to the end, please make sure that you jot our new phone number down, 973-567-PLAN. Again, that's 973-567-7526. That's it. Our doors, our phones, they're always open. You know how to reach us. Stay warm out there and let us design your freedom. Make it a great day and take care. Have a great 2026.
Take care, guys.